Alright, let's cut to the chase. Berkshire Hathaway's latest earnings report isn't just numbers on a spreadsheet, it's a potential turning point in the post-Buffett era. Here's the headline: operating earnings jumped 16%, but the real story is Greg Abel finally deploying Warren Buffett's legendary $365 billion cash pile. Wait, Buffett, the guy who famously called cash trash unless it's being used right, built this fortress of liquidity. Now Abel's spending it, but does that mean he's breaking from Buffett's playbook or just playing the same game with a different strategy? Let's unpack this. First, the numbers. $12.98 billion in operating earnings sounds great, but dig deeper and it's a tale of two companies. Energy, railroads, and manufacturing are crushing it. 24% growth in manufacturing alone? That's insane. But insurance? Up. Underwriting profits dropped 13%, and investment income from their insurance portfolio fell too. So here's the question: is this a temporary hiccup, or is Berkshire's insurance business losing its edge in a high-interest rate world? Personally, I think the insurance struggles are a red flag. Buffett built this empire on the float from insurance, cheap money to invest. If that's getting harder to maintain, Abel's job just got trickier. Now, the big move: buybacks. $4.5 billion in the last quarter alone, a 20x jump from Q1. That's not just spending cash, it's a message. By buying back shares, Abel's signaling he thinks Berkshire's stock is undervalued. But here's what people aren't talking about: why now? Is this a calculated move to boost shareholder confidence while the stock lags the S&P 500? Or is it a response to pressure from investors who've been screaming, "Do something with that cash," for years? From my perspective, this feels like Abel trying to balance Buffett's legacy of patience with modern expectations. Remember, Buffett held cash because he couldn't find deals. Abel's betting he can do better by being more aggressive. And then there's the elephant in the room: Berkshire's shift from net seller to net buyer of stocks. $20 billion in purchases after 14 quarters of selling? That's a seismic shift. But what's really fascinating is their new $10 billion bet on Alphabet. Warren investing in Google's AI play. This isn't the Buffett we knew. He avoided tech for decades, now they're doubling down on the future. Does this mean Berkshire's finally embracing innovation? Or is it a calculated hedge against missing out on AI's potential? If you take a step back, this isn't just about Alphabet, it's about whether Berkshire can adapt to a world where the old rules don't apply. Buffett's genius was in the margins, in boring businesses everyone else ignored. But in a tech-driven market, is Abel forced to play a different game? Let's zoom out. The stock's up 9% recently, but still underperforms the S&P. Why? Because markets hate uncertainty, and this transition from Buffett to Abel is uncharted territory. What many people don't realize is that Buffett's cash hoard wasn't just a safety net, it was a weapon. Now Abel's using it, but is he swinging for the fences or just poking singles? The Alphabet move suggests he's willing to bet on the future, but the cautious buybacks and measured investments in railroads and energy show he's not abandoning the past. So here's the deeper question: can Berkshire thrive in a world where the Oracle of Omaha isn't pulling the strings? Or is this just a calm before a storm when the market realizes no one can replicate Buffett's magic? Drop your thoughts, because I'll tell you this: watching Abel navigate this tightrope might be the most interesting finance story of the decade.